Good morning, everyone. This is Rob McDougall, Zhang Financial, here with your weekly economic update. Today is Monday, March 31st, 2025. So let's go over the economic data points that hit last week. And as we look at those, remember the backdrop here. It appears the U.S. economy is decelerating, concerns about a recession. So that's what we're looking for signs of, and also looking to see how inflation is trending at the same time. Because not only are investors worried about potential recession for the U.S., but stagflation, much like we had in the late 70s for you history buffs, where we had high inflation and little to no growth. So economic activity that was reported last week, we had new home sales that came in on Tuesday, very close to the expectations. 180,000 was a consensus, came in at 676, so that was okay. The next day, durable goods orders, ex transportation, in both cases, much better than expected. So the durable goods headline number was expected to be negative 1%. It came in nearly a positive 1%. That's positive 0.9. And when you X out transportation, was expected to be up only 2 basis points or 20 basis points. It was up 70 basis points. So that looked good. Initial jobless claims came in almost exactly as expected. 225 was the number, came in slightly below 224,000. Same day pending home sales. Percentage increase in February was expected to be 1.5%, came in at positive 2.0%. So good economic data. We go to Friday. Inflation numbers, PCE, core PCE, personal income, personal spending. It was a huge day, and here's the fly in the ointment, but it just doesn't appear that bad. So the PCE, the core PCE index is the only metric here that really was disappointing in that it came in positive 0.4% month over month. The expectation was 0.3. Now there's rounding here, there's all estimates, but nonetheless, it did come in at 0.4. Market really didn't like it, concerned for inflation. Although the headline PCE number came in exactly as expected, a 0.3% increase month over month. Now, personal income was expected to be up 40 basis points, 0.4%, double that, came in at 0.8%. And personal spending, that was expected to come in at 0.5, but came in at 0.4. So you would argue with those two metrics, personal income, personal spending, very favorable. Income higher, spending a little less, savings rate up, good, less inflation. Nonetheless, market really didn't like these numbers, and we'll look at the returns for the week. First of all, let's take a look at the GDP estimate from the Atlanta Federal Reserve. Here we are, March 31st, last day of the quarter, and the Atlanta Federal Reserve still thinks we're going to drop 2.8%, negative 2.8% growth in GDP for the first quarter. Again, the economists, whatever consensus is, virtually everyone's at least at 1% or higher. So no idea how they came to this number. One number that has been disclosed that they look at is net imports, and that is part of the GDP calculation. But the net import number, that can bounce around all the time. But I think one big factor with it is additional imports of gold, which have been reported during the quarter. So maybe making it look more negative, but nonetheless, negative 2.8% is what the Atlanta Federal Reserve thinks GDP negative growth will be in the first quarter. We'll take the over on that one. Inflation expectations went up slightly last week to 2.37% over the next 10 years. Again, that would be awfully favorable. If we were to average only 2.37% inflation for the next 10 years, I think investors would be pretty happy. So Fed funds futures, there is a Fed meeting in May, and for that meeting, the expectation of no rate cut actually decreased some. It was 88% week before. Probability now of no rate cut in May for the Federal Reserve is 80%. At the end of the year, 2 rate cuts at least. That increased. It was 48% the week ago. This moved up dramatically. It was 48% 1 week ago, moved up to 72% And now the probability of getting 3 rate cuts by the end of the year has also increased. It's at 39%. Let's take a look at the returns from last week. Negative week, just across the board. U.S. equities, international, fixed income, kind of flat. The S&P down 1.5%, but the equal weighted S&P down negative 0.7. Again, a favorable broadening out in the market, which is great. And value held up much better than growth again last week. Value almost flat, negative 0.2. Growth down 2.3%. So this is an important number and huge. If you take a look at growth in the United States, stocks, growth stocks down 8.7%, value up 3.3%. So last year, value definitely trailed growth. It did 2 years ago. But in 2022, in the huge downturn, value held up much better. We're seeing the same thing so far this year. Now, on a year-to-date, S&P 500 is down. It's negative 4.9%. Now, so not huge. But also point out that the S&P 500 equal weight, which really modifies the impact of the Magnificent Seven, that's only down 1.6%. Headline number with the Magnificent Seven at their market weights, negative 4.9%. In terms of international markets, down just as the S&P last week, almost the same magnitude. Developed markets ex-US minus 1.3. Emerging markets down about 1%, so very much in line with the U.S. International markets still, year-to-date basis, outperformed in the U.S. I mentioned the S&P down 4.7% year-to-date. Developed markets ex-U.S. up 7.5% year-to-date. Bonds last week, fixed income here in the U.S. flat. Bloomberg U.S. aggregate bond index down 4 basis points, still up a very strong 2.54%. Year-to-date, the 2-year yield dropped 4 basis points last week. The 10-year dropped 2 basis points. Economic activity for this week. Let's do a preview. The ISM Manufacturing Index comes out tomorrow. Now, we've talked about this one a lot. The fact that manufacturing in the U.S. has been in the negative territory, below 50, for most of the last 5 years. Last month, for the month of February, was actually over. It was 50.3, very encouraging. However, expectations is that will fall back and land for the month of March at 49.5. On Wednesday, we get the ADP employment change number. Now, this is contrary to what we're going to see for the non-farm payrolls, which comes out on Friday, which is flipped a little bit. But the ADP employment change, the consensus is 105,000 new jobs, which is significantly higher than the month of February, which was up 77,000 new jobs. Thursday, initial jobless claims. Last week was 224,000, expected to rise slightly to 225. But we also get the ISM services number on April. Again, that's a 50 demarcation line between expansion and contraction. Last month of February, up to 53.5%. It's expected to come down just a little bit for the month of March, down to 53. Lastly, the big day for economic activity, as is often the case, Friday. Non-farm payrolls, unemployment rate, average hourly earnings, and average hourly earnings year over year. So non-farm payroll, that is expected to be 128,000 new jobs for the month of March. For the month of February, it was 151, so deceleration there. Unemployment rate is expected to tick up just 10 basis points. So for the month of March, that was 4.1, expected to come in at 4.2. Average hourly earnings are expected to come just exactly what we saw in February, a positive 0.3%, which would equate to a trailing 12-month number of 3.9%. So that's it for our economic recap. We thank you so much for visiting. Hope to see you again next week. Thank you.